Welcome back to Bullish. I am Sam Hardy, joined as always by Nick Stenger. We are Stenger Family Office. For the past 42 long years, it has been our mission to deliver both clarity and confidence to help secure your financial future. Episode number 6. Thank you to those of you who have listened to us, continue to listen to us. Another great week here. Fairly retail heavy again, but some exciting ones mixed in, some good ones that we'll get Nick to talk about. I will say this episode is in honor of Jimmy Buffett. Nick will be doing a little karaoke later, so stay tuned for that. The audience will love it. Beautiful voice of an angel, if you ask me. We are talking about angels later, Victoria's Secret angels. We're also talking Best Buy, Big Lots, HP, Pure Storage, Salesforce, Crowdstrike, Chewy, VMware, Broadcom, Dollar General, ChargePoint, Campbell Soup, and Lululemon. Remember, not individual stock advice, past performance, not a guarantee of future results. Stenger Family Office and its clients may not hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. Nick, take it away.
What's going on, Sam? How was the week? I think I will say, you're doing pretty good for looking like you were about to keel over yesterday. I don't think you were feeling your best. You sound a little stuffed up. Not too bad. How are you feeling? You feeling better?
Yeah, allergies got the best of me. Kids being up in the middle of the night also got the best of me. As you know, Norris was yakking in the middle of the night, so I had a nice couple of hours that I was up on Wednesday night. So not the most fun. Thankfully, he's better. Had to cancel some weekend plans, but unfortunately, it is what it is.
Well, I'm excited, and I guess I'll have to bring the energy then on my end this week because you're a little bit more subdued. But maybe we can get you in the mood when I do some Jimmy Buffett karaoke at the end. I was singing Margaritaville before we got started. Will not be singing it live on air. You do not want to hear that.
No, nobody wants to hear that. Well, I mean, potentially, but not I, and probably not anybody listening to the show. Hate to say it.
Question for you, buddy. Are you a sing in the shower guy?
Yeah, I am. I enjoy singing in the shower. Usually once everybody's asleep so that they don't hear me. That being said, I think I'm pretty good.
Oh, interesting. Well, that is the only place I am singing. Once in a while in church, I'll sing. I'll belt it out here and there.
You don't sing in the car?
Not as much. I leave that to my wife, and the minute she starts singing, my baby's crying. So
I was going to say, should we talk about if our wives are good singers or not, or should we just
I already
let's just
that
let
subject,
that one
so
slide.
Let's
okay.
Move it along.
Yep. All right. Best Buy. To start it off here. Beat top and bottom line estimates, revenue north of $9.5 billion. It was a 7% decrease year over year. Both domestic and international segments saw the decrease. By product segment, it was actually computing, mobile phones, and appliances that were the biggest decreases for them as far as revenue and sales go. Earnings per share down north of 7% at $1.25. Net profit margin down slightly. Stocks down almost 2%. Reading CEO notes, obviously they want to make everything seem better than it is, pull back the last couple years in consumer demand for personal electronics, but hoping to see some stabilization this year.
These guys have managed incredibly well given the terrible environment they have to operate in. It's a retail business. It's in it's commodities. You can get all this stuff online. You can get it on Costco, or you get it at Costco. We bought TVs for our new office. We bought them from Costco. It's tough. And a lot of people still do the whole thing where they go to Best Buy to, sort of like window shop, and then they go online and try and find it cheaper somewhere else. So it's just a tough business. I will give them credit for how well they've managed through such a tricky environment. Stock is up 42,000% since 1985, so you can't fault them for any of that. It's just a very, very tough environment they're operating in, and I think long run it's going to be the growth story, or the lack of growth story, I should say, that's going to drive the valuation lower. So right now it sits at a 12.5 PE ratio, and it really probably should be somewhere in the 10 range. When you don't have a whole lot of growth long run, you are going to trade at a lower multiple. That's just how it works. So that's my only concern with these guys. I wish them well. I think I like going there once in a while. I just ordered a phone charger from there because they had a higher quality one than I could find on Amazon. Phone chargers always kind of breaking and things like that. So just got one from Best Buy, but it's just so tricky. We didn't even consider Best Buy when we bought those TVs. It just didn't even pop into our minds. We were at Costco getting some other stuff, and we loaded up, 3 or 4 TVs for the office because they were cheaper. So it's tough. You're in a commoditized industry.
Yeah, well, Costco does a good job putting them right at the front as well. It's not the first time I've walked in and walked out with a TV. Now, I know we were going in planning to buy something. I don't think we were planning on buying 3 or 4. That being said, you see a good deal and you take it. So I know they have their price match, but that makes it a lot harder for them when other people are already pricing that low to begin with. So let's do Big Lots here. Big Lots is challenging Peloton for biggest loser, in my opinion. Down 91% from its April 2021 highs. Not profitable. If we look at earnings, they did hit top-line estimates, but it was a decrease 15% year over year. If you look at comparable sales, seasonal stuff down 26%, furniture down 18%, home down 12%, consumables down 7%, food down 5%. Stock is down another 5.5% since earnings were reported.
I can't believe you said that. That's a horrible thing to say about their stock. It pays a 20% dividend. You're saying you don't want to buy it for the dividend?
Well, if you've listened to previous shows, Nick loves buying stocks that have over 5% dividend yields because it usually means they've got really solid balance sheets.
You know what? It's crazy. You could actually go out. Somebody could buy all of Big Lots for $171 million. Look, I have nothing against them. But it's just a tough business, man. It's just really tough. And if you've ever been in a Big Lots before, you would know to not buy the stock. They used to have one right by our house. And, we'd go over like once in a while, and it was just atrocious. So I don't know. I wish them well. I have nothing against them, but, man, what a terrible story. For investors, it's been just a bloodbath. It did trade at 68 in 2021, April of 2021. After trading for, 12. It was $12 a share, March of 2020. Now, if you timed it, great job. You get the clapping. You get the, let's see if we can put it on here. Great job. You nailed it.
You're up 480% if you time that trade perfectly and then
Yes.
get out before it tumbles 90.
Get out, pay all your capital gains tax, and then look for the next one. But who knows? I guess maybe there are some people that did that. But you could have bought this thing in 1989 for basically the same price that it trades for today. So this has basically been just capital getting lit on fire. They should shut it down and do something else with their lives. That's my opinion.
All right, HP. Missed on the top line, hit bottom line estimates, revenue $13 billion. It was a decrease of 10%. If you look at segment, printing was down 7%. Their personal systems segment down 11%. If you look at regionally, they were down everywhere there, obviously. Americas, Europe, Asia Pacific. Earnings per share down 30%. Stock is down about 6.5%. A little bit of a correction there for them.
I don't love this one. Now, I think we had talked about this a couple weeks ago, that they actually separated out the enterprise business from basically like the hardware business. It really hasn't made a huge difference for them. Obviously, the enterprise stock is up 30% the past year versus 8% for just general HP, but it really hasn't made a long-term difference for them. The only change, and they actually both pay a dividend, HPE and HP, but the only change is they did get a much bigger multiple on HPE, the enterprise. That's like their cloud computing, all that kind of stuff. I actually met one of their top sales guys. Really, really interesting story. I don't know. I'm not buying this thing. I maybe at some point we buy it again. It would have been a trade. Let's say 2022. You came in at 25, and now it's 30. So not a bad trade, but again, it's just that it's a trade. It did get hammered in 2020. But other than that, I don't know where the long-term growth story is. Maybe you go towards HPE because it's got that cloud narrative and all that. But who knows?
Okay. And HPE you're out on as well, both of them?
I'm not buying it. Yep.
Okay. Pure Storage. IT Pioneer, delivers advanced kind of data storage technology and services there. Beat top and bottom line estimates. Really strong quarter for them. Almost $700 billion in revenue. It was an increase of 6.5%. $1.2 billion in recurring annual revenue, an increase of 27% there. So really strong moving forward. Also 26% increase in their remaining performance obligations. So stock's up 7.2% and continues a great year for them.
Yeah, interesting company. We don't own it or anything like that. I'm not buying it yet. I don't think there's anything wrong with it. I think they certainly had a nice little growth story. Thing has done very well this year. 5-year return on it it's okay, up about 37%. It's a $12 billion market cap. I don't know. There's better investments out there, but I don't know if like a lot of this stuff got hyped up during COVID, and that was part of the issue. Again, you could have bought this thing at $18 pre-COVID. You could have bought it for like literally under $10 in March of 2020. So it's had a nice run since then. But the longer term story is they're not profitable. I don't think they're profitable, right? Did you pull that up at all, Sam? I think their revenue here for fiscal year.
No, they're not.
Q3 fiscal year 2024 revenue is $760 million. I love how they report these non-GAAP operating margins, which if you listen to Warren Buffett, he'll tell you is a disaster. Watch out for that. Anytime they're making up their own metric for profitability, probably not a good sign. But they did have
all the stuff that I read is GAAP. Whenever I see the non-GAAP stuff, I just ignore it.
Yeah, that's like a management created metric. I don't know how you can't rely on any of that stuff. You can say whatever you want, but the reality is net income's net income. Now, they were profitable the second quarter of last year. They made $11 billion, I think. Is that right? Does that sound right?
Yeah, it looks like it.
Let's say, or no, was it $1 million? 11 million, yeah. And then they lost $7 million. So, yeah, I don't know. It's just they took a massive. If you look at their losses, they took a impairment loss, which could actually make them profitable on a go forward basis. So I shouldn't talk too badly about them. On a go forward basis, they actually would have made $10 million. But on $688 million in revenue, that's 1.5% margin. Not so great.
Yeah, they've got a lot of work to do, to say the least. Okay, let's do Salesforce. Top and bottom line revenue smashed it, $8.6 billion, which was an 11% increase for them. Strong growth across all product segments. Data was actually their biggest kind of growth engine there, 16% in revenue. If you look at geographic segments, most growth actually for them was in Asia Pacific. It was about 24% in growth there. So current remaining performance obligations for them are at $24 billion. That's up 12% year over year. Operating margin, they were able to increase 1,400 basis points. Earnings per share up 1,700%. Stocks up 5%. And continuing to kill it this year. I mean, if you look at it, it's 65% year to date, I think, last I looked.
Yeah, so the growth was about 12% year over year. Definitely doesn't support 140 PE ratio, I can tell you that. That's the problem I've always had with Salesforce. I understand it. I understand the product. I totally get it. We use it. But the current PE ratio is 140. The forward is 62, and they only grew 12% year over year. I don't understand it. And we listened. There's Josh Brown had somebody on the compound who was talking about the same thing. He is a value guy. We're not necessarily value investors. We're more core plus. He is a true value investor, so obviously I get why he has not touched this thing at all. It's one of these companies where, I totally get the story. I totally understand what they're doing, and I like the product. It's just I don't know how you could possibly justify these prices. It just doesn't make a whole lot of sense. And this thing has been wildly volatile, $307 a share in 2021. The low in 2022 was 128, somewhere in there. Got absolutely hosed. again, it was a big trade. If you could have bought it for 128, now you're sitting on 223. I bought this thing for 225 in 2021, and it's been dead money. It's been dead money for 2 years. It's been a disaster. So it's not a part of our portfolios. This year it would have been helpful. It's up 66%, but I cannot justify 140 current, 65 forward, or 64 forward with a 10% growth rate. It just doesn't make sense.
Okay, CrowdStrike beat estimates as well. Revenue up 37%, a little north of 700 million. Large part of that being subscription revenue, which is great for them, up 36%. Their annual recurring revenue was almost $3 billion, also a 37% increase year over year there. So they also, made a point to mention 63% of their customers have 5 or more of their module cloud subscriptions. So that's obviously a great sign for them. Earnings per share up 114%. Seems like they're positioning themselves well for the future. Stock's up 13.5% and it's really bounced back this year after a rough couple of years there.
Yeah, I really like the story. I like the cybersecurity story. Now, these guys are not overly profitable, I don't think. We can pull it up here, but one of the story behind this really makes sense. And you just have to be careful with stocks like this. And we talked about Palo Alto Networks, which is a holding in our portfolio, a significant holding. It's done very well, been one of our top performers the past 5 years. But the only thing you have to make sure you're being careful of with these is you're not just buying it for the story, that you actually are looking at the earnings, you're looking at what they're doing. They're barely profitable, just barely. They made 4 cents a share in this last, or 3 cents a share on a diluted basis this last quarter. So it's not overly profitable. They are getting the revenue growth rates, which is tremendous. And so they kind of break it down into subscription revenue versus professional services, which I assume is some form of consulting. I don't know if you know that, Sam, if it's, if that's how they consider their professional services to be. But that consulting business is up 46% year over year, which is absolutely nuts. And then their subscription revenue, the growth rate was 36%. Absolutely insane. The gross margin on the subscription alone, so they publish all that obviously, is somewhere in the 78% range. So they're just basically printing money on a gross profit
subscription
basis.
Side of things.
Yeah, and the professional services obviously is going to be much lower because you have a lot more staffing costs. It's kind of reversed actually. It's a 30% gross profit, so it's literally the exact opposite of the subscription business, but it's still profitable. I think the thing that always hurts these guys in the short term, and then you have to figure out long run if it's going to help them, but the only thing that hurts these guys is they do have to just have so many people there to scale. And if you look at I'm sure if you pull this up, it would pop up on LinkedIn. I can do it right now. With tech stocks, I always look at their hiring trends because that's what's going to affect profitability. So look at these guys. The past year, their headcount on LinkedIn alone has gone up 15%. 2 years, the headcount's gone up 71%. So that's the only issue. Now, at a certain point, they're going to cut headcount. They will become a lot more profitable. That's just how all these things work. Like Facebook had to do this. Amazon did this. All these places, Google's, layoffs, all that kind of thing. So they will get profitable. You just have to figure out the right entry point. Obviously, the wrong entry point was when it was $284 in November of 2021, and you're sitting on dead money now for almost going on 2 years. I think that's the risk on these things, is if you get them for the right price, then you're golden. If you get it for the wrong price, it's tougher. And from a performance standpoint, things up 160% the past 5 years. It's just trailed Palo Alto Networks. Again, that was our pick. Palo Alto is up 218% the past 5 years. So a little bit bigger market cap than CrowdStrike, but I think the general thesis is good. The growth rates are there. And just to make a last comment on Salesforce, because we're talking about growth rates, these are the kind of growth rates that you would expect on a stock that's trading at 7-8 times sales. You wouldn't expect that on 12% growth. And that's just what you have to watch out for. I think the growth is here. The growth story is there on CrowdStrike. Longer term, it's going to be, all right, let's get it for the right price. We may look at it at some point. It's just not a holding for us right now.
All right, Chewy, beat estimates. I will say estimates can be misleading sometimes. Like Big Lots, they beat their estimates. It's also, to your point, people who use non-GAAP accounting and kind of can manipulate that. It's like, I mean, you can do whatever you want with estimates. You can drop them lower. Obviously, the analyst, the street's going to know what you're trying to do. And if you drop your estimates way down and still beat them, it doesn't necessarily mean anything positive is going to happen as far as your stock price goes. Obviously, that's the case here. So to almost $3 billion in revenue for them. It was a 14% increase. Margin basically flat, so they haven't really been able to capitalize on that revenue growth at all recently. Net income down 15%. I was reading an article on Seeking Alpha about them, and they mentioned how medication and health insurance lines for pets kind of seem to be the potential source of growth for them. The only reason I can see that is because some people literally treat pets like they're humans. Like, we obviously have kids now. We've had dogs at points. I mean, dogs are great. They're fun, but they're not kids. And, I think that's where most people come around to long term. But stock's down 13.5%. Continues a tough year for them.
Yeah, they're actually a really good company. They're very well managed, very, very neat story. They're notorious. They're what they're best known for is when somebody has a dog like who's like sick or like a birthday for their dog, they literally will write you a handwritten card. We've used them for dog food now, and it's like the Amazon of dog food. The only issue I really have with Chewy, we don't own this thing, we're not going to buy it. The issue I have as an investor, or if I were an investor in this thing, what I'd be really worried about is it's just, to me, not differentiated enough to beat Amazon in the long run. And I think people are eventually going to chase value there. And, look, maybe you pay by the way, I know for a fact you have to pay a little bit more with Chewy on different products they have. They obviously try to get you on a subscription membership, but that's not a very profitable business. Your biggest problem there is, again, you're shipping dog food that's 50 pounds or 40 pounds for next to nothing. And I just don't know how you can sustain that long term. They are profitable, very slightly profitable. They will trade roughly around 143 forward price to earnings ratio. I don't know. I like the idea of it. I like the company. We are a client. I'm just not an investor.
Yeah, did you see what happened during COVID?
Yeah, massive spike. Yeah,
when I was
got a
looking
dog.
it up too. Yeah, it was up 300%. I think there was like a 10% increase in people who owned pets during COVID. So they capitalized on that well. But, obviously that's a very different situation than we find ourselves in now.
Yeah, I mean, look, I actually disagree from the standpoint, I do think the pet thing is going to continue for a long time. Okay, people are just not having kids anymore, and you can see that in all the data, and they are just having dogs, right? They're just having a dog or two or a puppy or something, a COVID puppy, and that is a good trend. It's just, where are they going to go long term for the stuff they're buying? You have to somehow get them to remember, okay, I'm going to Chewy.com, I'm going to Chewy.com over and over and over. Maybe they can do that. I don't know. Personally, we're going to Amazon, or we'll go to the local pet store if we need something last minute. That's my only issue with it.
Okay. VMware missed top and beat bottom line estimates. Revenue increased 2%, $3.5 billion. Subscription and SaaS revenue was up 34%, made up 37% of their overall revenue. Net income up almost 38%. Stock's down a little north of 1% since the release here, but we'll have to wait and see what happens here. We're actually covering Broadcom next, but seems like VMware is going to be acquired later this year by Broadcom. I think that's valued at like $60 billion. So, I'll let you comment, and then we can run to Broadcom.
Yeah, so I just pulled up Morningstar actually published a piece this morning, and they like the deal with Broadcom, it says. They said, we're raising our fair value estimate, which, by the way, you have to take those with a grain of salt because Morningstar's fair value is not always the best, but what they're saying is we've raised our fair value estimate for VMware to 180 from 161. High uncertainty and standard capital allocation ratings. Our fair value estimate increase is purely due to raising our probability of the pending acquisition. So if the deal doesn't go through, they say that they're going to remain at 175 fair estimate. They could get blocked on this deal. I mean, the Biden administration has been very aggressive on pursuing these on going after antitrust and all that. Broadcom, which the ticker is AVGO, that's been a holding in our portfolio, one of our best performers as well. Really nice 5-year number there, 260% the past 5 years, trading at a $352 billion market cap. So I don't know, they could get blocked. I don't think they should get blocked. That would only make it a
the UK approved it, I know.
Oh, okay. Yeah, then they'll get approved. That's a good point.
Yeah, looks like back in July they were talking about how Europe greenlighted it. And I know too. I was reading something on, what were you saying?
Weren't they a spinoff? Yeah, they were a spinoff of a Dell or something like that. It was Dell EMC, I think.
Yeah, I believe Dell owned them before.
Okay.
I do remember reading something on that too. I was reading too. Investopedia just put an article out on the acquisition. They actually valued it at $69 billion at this point, even though it was initially valued at 61. Maybe the AI boom has kind of been a catalyst for that increase in the value. But I mean, really, Broadcom is just a massive semiconductor company. That's where they get all their revenue from. And so this is going to kind of help adopt the cloud technologies and also give VMware a little bit more capital and financial resources to increase their research and development ambitions, is basically what was said there. So it's kind of a win-win for both, but obviously Broadcom's the beast in this.
Yeah, I mean, Broadcom's had some actual antitrust issues. Like they were making a potential bid on Qualcomm back in the day. I think it was 2018, somewhere in there. Didn't go through. It looks like there was a deal that went through with Broadcom and CA Technologies. So that went well for them. Yeah, they're in the, they're going to say we're like a cloud business, which makes sense. I really do like Broadcom. I mean, there's just not a whole lot of good, profitable plays on this stuff, and Broadcom is one of them. So I think just Broadcom as a standalone is probably a good spot to hang out. It's a decent sized position in our portfolio. We're not going to do anything with that. It's probably a little rich on a valuation standpoint now, but I wouldn't panic anytime soon.
Okay. Yeah, I mean, they'd been strong. Revenue for them was almost $9 billion, increase of 5% year over year. You're looking at net income up 7.5%. So they're down a little bit since the earnings, but like a lot of these kind of companies within the semiconductor and AI kind of space to some extent, they're up 55% year to date. So have had a strong year so far. Okay, let's talk Dollar General. Missed all estimates. Revenue, $10 billion. It was up 4%. Earnings per share, however, down 29% roughly. Similar to Dollar Tree, which we talked about on last episode. Hard time managing the bottom line, hurt by this inflationary environment and pricing inefficiency to some extent. So, it seems like they're doing a revamp to some extent. They mentioned completing 850 real estate projects during the quarter, but I mean, stock's down north of 20% and had a tough year. I mean, basically this year's wiped out their past 5 years in return.
Yeah, I've been actually really shocked by this. We bought it way too early. I would completely admit that. We bought it before earnings came out, like for, I don't know, we paid $150-ish roughly, or right after earnings came out. So we were early on it, and we're down temporarily, about 15-16%. So we definitely jumped too soon. There were a couple large Wall Street banks that jumped on it pretty soon, even earlier than we did, like at the $200 mark. I've been really, really shocked. Now, this isn't the first time I've seen these dollar stores get pummeled. It's happened very often, not very often. It's happened a few times. There was 2020, October of 2020 through March of 2021, and the thing was down about 11%. There's been other periods where it's been down, like 2019, it was down about 25%. This is pretty significant. This is a pretty serious drop-off. It was in the 250 range. Now it's 125, so it's effectively gotten cut in half. So I don't know. We added it to the portfolio, not much, 0.5%, but we're going to stay put. We're not selling it. I just think it's just operating in a very interesting environment, and it's going to trade on sentiment. People think inflation's coming down, and they're going to say, oh, their average customer makes $40,000 a year. This is obviously a nice spot for people to be able to go and afford their items. I just think it's a temporary decline. I think it's going to come back.
Yeah, well, they're all over the place too. Anywhere you go, you can find a Dollar General. They have stores literally everywhere. They're like Walmart too.
And by the way, another stat with these guys is their average customer, their core customer, pays in cash. So it's really important to know that, because a lot of these people are not, their competitor is not Amazon. So you really have to keep that in mind. I tend to think the inflationary story will continue. I don't think we're completely out of the woods on inflation. And so if I'm correct on that, then I think something like this actually rebounds, recovers, and does fine.
Okay. ChargePoint, very different from Dollar General. It's an EV infrastructure company for charging, missed all their estimates. I mean, revenue was up almost 40%, but net income was down almost 40%. Gross margins went from, and this is GAAP reporting, 17% to 1%. They did announce that they're laying off about 10% of their workforce, going to make other cost cuts that should total around $30 million in annual operating savings. So trying to save that margin, but stock's down 13%, 30% on the year.
All right, I'll make two statements. One, I think ChargePoint's going to zero. I'll just say that. I've never liked the idea of this thing. I had one client who bought it on his own. He made a bunch of money because he timed it perfectly. I'm talking like he got in, I don't know, in the $5, $6, $7 range or something like that. And then during COVID, it went up to 40, 46, and he sold it right at the top. He made a boatload of money. Now the thing's back down to just under $6. I really don't think these guys can make it long term for a variety of reasons. And then the other thing else, and the reason for that is because Tesla's just going to make a competitor, right? Tesla wants to take over the EV charging grid. They want a monopoly over charging, and they're going to get it. I really believe that. Elon Musk is brilliant. He'll figure it out. They already have their own network. You don't need ChargePoint. Obviously, they have them at the grocery stores. They have them all over the place. But eventually, the EV companies, I think, will just either make their own network. They'll have like a I don't know, a group of networks or something like that. But they're not going to have to use. You're not going to have to use ChargePoint. That's why I think long term the growth prospects just aren't there. The other thing is, I just am, and this is not a popular opinion, but I just am not a believer in what they're doing in general. I think it's ridiculous to think that you're going to run the whole world on green energy. You can't. Obviously, we all want cleaner energy. We don't want it to be a haze when we walk outside. But I don't see how you're possibly going to convert every single vehicle to electric. You just can't. It takes a bunch of oil just to make the car in the first place. And so I don't believe in the thesis. This is not one that I think is sustainable long term. I don't think that this is really a business model that you want to be allocating dollars to. It's kind of like the solar panel thing. I don't know. Everybody talks about how great solar panels are. Well, guess what? When the batteries expire, it costs thousands and thousands of dollars to replace. Anytime there's a fire issue, the stocks go down. So I just am very, very cautious on anything having to do with EVs at this point. I'm sure I'll be wrong. Maybe EVs will take over, but I'm not putting dollars into it.
Well, to your point too on Elon, GM and Ford mentioned in all their cars moving forward from 2025, they're going to be compatible with Tesla chargers. So you're talking about two of the biggest manufacturers here in the U.S. are saying, yeah, we're going to adopt to what Tesla has. So let's do Campbell Soup then. Hit top line, basically right in line with their bottom line estimates. Revenue grew north of 4%, about $2 billion by segment. Meals and beverages were up about 1%. Snacks were the big winners, up 7%. They do own Goldfish. I do love Goldfish. I have seen Nick snacking on Goldfish after he eats a salad for lunch. Sorry, Jamie. I have to call him out. I will say they are acquiring Sovos brands, so that's a pretty big move for them. They're the maker of Rouse sauces, delicious pasta sauce. Deals roughly 2.7 billion, and something I read yesterday. Net income and net profit margin were up 76 and 69% respectively. Stock's basically flat. It's down like 0.5%, something like that. But bouncing back from a little bit of a rough patch, maybe.
Yeah, I actually made some money on this as a trade a while back, and we never did it for clients because we always felt it was a trade, and clearly that's been the case. The 5-year return on it's been 1.5% without the dividend. The dividend's 3.5. It's an inflationary play, so that's why it ran up during the COVID era. Again, if you depending on your position on inflation, if you think inflation is going to continue to go up, people will be eating lots of soup. What's interesting is they bought Rouse, which is not necessarily a low-cost item. I don't know if you've seen Rouse lately. $10 for a jar of tomato sauce?
Yeah,
It's good.
It's definitely a little pricier. And they own Prego, Campbell's does already. So they're almost buying like the higher end line of sauces as to what they already own.
Yeah, it's almost like Campbell's is taking their own position on inflation and saying, oh, inflation's not going to be that bad. We're going to buy the premium player, charging $10, $11 for a jar of tomato sauce. When Prego, I don't know how much Prego is, like $4, $3.50 or something. It's not much.
Yeah,
Let's
Rouse
see.
is $10.
Yeah, $2.50. So clearly Rouse is this massive, massive premium. Again, you have to take a stance on inflation when you buy these things. That's why we try not to buy stocks like this for our clients, because you have to be right on the direction of interest rates. And if you're wrong, you have no return. That's why the thing is down. What's it down? 25% for the year. So that's that would be my issue with it, is just where's the long-term growth story other than an inflationary environment, which some people think we're leaving. I think we're going to be in for a while, but I'm still not going to buy it.
Okay. Victoria's Secret. No, we talked Bath and Body Works last week. This is another Les Wexner company. Missed estimates continue, kind of a brutal year for them. I will say they do put Victoria's Secret Angels on their earnings report. So when my wife walked behind me while I was working on doing the research, she was like, "What are you? I'm working. What do you want me to do? I can't hide the fact that they're doing that." Anyways, it was all fine. I just went and I pulled the paper report instead as the same info. Anyways, revenue down 6%, $1.5 billion. Store sales down 15%, which is their biggest segment. They did have growth in direct, up 5%. International was up 24%. Net income was down 100%. So they're closing down as many stores as they're opening these days. Stock's up about 50 bips, but on the year it's down over 40%.
Is this an issue? And I'm really not qualified to talk about this, but let me just ask you. I don't know if you know. Is this an issue because people are buying this stuff online? Or do people, I see the stores, obviously, at the mall, but are you going to the store for this kind of stuff, or is it just online?
I think it's a combo. For us, what we buy to wear under our clothes is a lot easier. I think that to some extent, women want to make sure what they're wearing is comfortable and fits correctly, which is easier to do in a store. But nowadays, too, we could compare it to, like, when I buy shoes or things of that nature, I'm buying 2 or 3 different things, and then I return the 2 that don't fit. I'm buying 2 or 3 different sizes, depending on what it is, and I just return what doesn't work. So I don't know if that's having an effect on it, but that's the only thing I could see where the store still holds value. They used to be in every mall. They still are to some extent.
Are they?
I should ask my wife, done a little bit more research, if she still goes to the store or not. But
are they having an issue with like theft and stuff? Is that part of the problem? Have you read anything on that? Because I know a lot of these retail companies are dealing with a lot of theft.
I didn't see anything on that, to be honest.
One of the big problems is like the comparable store sales, because that's like what you said. They'll open a store, close a sale, or close a store, But really, to even that out, if you take out the openings and the closings and you just look at same store sales, down 11%, that's not fantastic. That's not a good sign. It's maybe, I always thought it was premium, but maybe it's not premium. Maybe people are pivoting towards higher quality, more premium options. I know my wife has complained in the past that their quality is not that great. So I don't know. I really have nothing. I don't have any insights here. I just know the stock has done terribly, and I'm definitely not going to be buying it.
All right, fair enough. Now, we will finish with one. I mean, I would argue that I am an expert on purchasing things here, but Lululemon beat estimates, revenue of north of $2 billion, up 18%. Growth, if you're looking at women's stuff, they were up 16%, men's up 15%. Huge international growth for them. Their international sales were up over 50%. So they opened 10 net new company-operated stores. They're sitting at 672 globally now. Earnings per share up 18.5%. Stock over 5.5% in growth here since earnings came out. I will say this, though, and I just remembered this note. As I was looking at this yesterday, it is on Kramer's watch list.
I literally just pulled that up. I have it up right now.
Take that into account. I'm just saying, I don't want to call the guy out 2 weeks in a row.
Short it.
Yeah. I will say I do love their clothes. If I'm not wearing a suit, I'm usually wearing Lululemon, and it holds up over time.
Well, his other picks were Airbnb and Chipotle, so not a great sign. We'll have to see. I'm not bullish on Airbnb. Chipotle's been okay. Lululemon, oh man, I feel bad. Get out the funeral songs for Lululemon stock. But you know what's really sad about this one?
Violin.
you know what's really sad about this one is I bought it at 45 in 2011. I sold it at 80.
Oh goodness! And you thought you had a winner back then.
Oh yeah. I remember calling my friend and my friends in the investment club. I was like, "Hey, look at this trade. Look how great I did on this trade." Sure enough, here it is, $400 a share.
Wait, when did you buy it?
It was in college. It was like 2011 to 2013, somewhere in that range. It was like one of my top picks at the time. It was such a short term. I remember sitting in class and actually trading it. Despite probably I shouldn't have been on my phone. You know what? If I had listened to the professor,
it was an economics class. It was an economics class, and you guys were talking stocks. I'll tell you that much. And you were like, "Oh yeah, professor, I'm buying Lululemon right now. All right, talk to me in a couple of years when I'm loaded from this trade." But then you sold too early, so sorry, didn't happen.
Well, nobody agreed with the trade either. I mean, everybody was like laughing at me, like, Lululemon, really? You're selling yoga pants for $120 that probably cost $5 to manufacture. Well, yeah, it turns out that that's a great business.
Yeah, I will say though, their stuff does hold up better than a lot of other places. Like I was getting this stuff in college 10 years ago. I still have one of the shirts. It's held up over time. I can still wear it. It made it through kids, taking it through the ringer. I mean, I like it.
You know what's nuts is
personally
their revenue number is up 18% year over year. They have a better growth rate than Salesforce.
Yeah.
Like if you had to pick a growth stock and cross your fingers and hope you paid the right price for it, I would buy Lululemon. I'm not, just to make it clear, I'm not buying this thing right now, but this is the one I would pick over Salesforce all day long. 32 forward price to earnings ratio with 18% year over year growth, and they're very profitable. 341, is that millions? Yeah, that's millions.
Yeah, 341 million.
341 million in profit on what, 2.2
billion.
Yeah, so decent margins. Man, look at that! Look at the gross margins on this thing too. For a retailer, 60% gross margins pretty consistently across the board. Actually, their gross margins are up year over year. Think about that. That's wild.
Well, they also know that they can just, like, at this point, even if they up the price of their pants $10, I'm still buying them because they're the best in my opinion.
I think they are.
Do we think did work from home affect this at all? People
It
all
might
of a
have.
sudden get into the athleisure stuff. They don't have to go into the office as much. I mean, even think about all the guys that we know in the industry who, they went from having to wear a suit. Everything's a little bit more laid back. You can get by with nice pants and a polo or a dress shirt. How many people do you know that tuck a dress shirt into a pair of Lulu pants and call it a day? And it looks nice. You can't tell the difference.
Yeah, for sure. I mean, here's a good question, because you and I are obviously big into suits. We're big suit guys, and we require suits at our office every day. I'm not wearing my tie today. I thought you would not be wearing your tie, so you're definitely making me look bad here. But I think, like, from my standpoint, we wear suits because we just like to, like personally, I like the feel of it. I think it makes you look sharper. None of our competition wears suits anymore, so we're sort of unique in that regard, and I think that helps us long term. I think it's a good look. It's just it looks so much better. You and I were in New York City for that due diligence not too long ago. Guess what? New York City, everybody on Wall Street's wearing a suit. It just is such a better look. Do you think at some point classier dress clothes come back? Do you think that the suit look comes back? I think everything's a pendulum. I think everything changes. Everybody looks like a slob now. You go to the airport, people look like they just woke up, rolled out of bed, wearing their pajamas. Does the trend of flying in a suit or wearing a suit to the office, does that ever come back?
Yeah, I think so. I think, I mean, even as we look at the work from home, everyone's, nobody's ever going back to the office. Our whole entire country is going to be working from home now. I mean, we talked about this 2 or 3 weeks ago. Zoom is requiring that people come back into the office now. The company that benefited the most from work from home is now requiring people to come back to the office. It's, is it going to be what it was as far as suits go? I don't think so, but I think that they'll make a return, more than what we're seeing now. I think we will see a little bit more of an uptick back to that.
Yeah, I actually have a client who's he sells all that stuff, so he goes to buying shows and like trade shows and all that stuff, and his main line was a high-end suit supplier, and that was just massive for years, and then you saw kind of that decline. I mean, how many times can you go on Nordstrom.com? You're looking for a suit. You can find a high-end suit that's a $2,000 suit for half off. It's insane. It's almost kind of sad that they have to give these things away. And he said his athleisure line, the casual suits, the sport coats, has been off the chart. And obviously the full suits and like the three pieces are non-existent anymore. The only guy wearing a three-piece is Jordan Peterson, which I would argue is a really classy look. Here's, from an investment standpoint, why I do think that things are going back to higher end, classier, the suit look. Because you have all these people, and Peterson talks about this all the time, his lectures, people literally dress up for them. And it's a lot of young men. It's a lot of young men who have been told that they're no good and they don't have their lives together, whatever it is. They read his book, 12 Rules for Life. They go, you know what? I'm going to turn myself around. I'm going to get my life together. And he always talks about how your outward appearance is a factor of what's going on inside. And so these people, they want to buy suits. He's wearing a three-piece. I don't know if I'll ever wear a three-piece every day. Don't think I can pull that off unless I have a big cigar and drinking whiskey at work. So I don't think I'm going to that mode.
Maybe when
soon.
We're older.
Yeah,
maybe
years.
when we're at the end of our days, we'll wear three pieces and smoke cigars and drink whiskey during the day. But who knows?
Yeah, but I do think, I really think long-term call, and I could be wrong for a long time. I could be wrong for 10 years or something like that. But I do think eventually in our lifetimes there will be a pendulum swing back towards wearing fancier clothes. And I think people are going to get sick of the sloppy look. Like you said, with work from home, all these things go in waves. I always love those videos of the 40s or the 50s that they had where literally everybody, you're standing in the soup line and you're wearing a suit with a top hat. It's just, it was a
when
different
we looked
look.
at Nordstrom, remember they were talking about I've seen so many pictures of downtown San Francisco where the Nordstrom store originally was when people started shopping there. Literally every single person has a suit on. All the women are in these beautiful long dresses, cobblestone streets, all that kind of stuff. And yeah, to your point, I mean, I do think that they'll come back eventually. It's just a matter of time. and
Yeah.
who is kind of the icon of that time. Jordan Peterson's obviously, to your point, somebody that a lot of young men pay attention to because of what he stands for and what he encourages, in some of their lives. But
Which, by the way, why is that so bad? Why is it bad to go to all these people who are struggling and try and help them? I really don't. And I get he's gotten into politics more recently that, a lot of people are upset about. I
which
get
is
that.
when he started having issues. People started having an issue with him.
Yeah, nobody gave him trouble when he was just telling people to clean their lives up. I don't get that. The guy's just going out telling people, listen, pull it together, look good, feel good, get your life together. What's so bad about that? But not and last thing I'll say about this whole conversation is not to ever knock the work from home, because I think there is a place for that. And certainly like single mothers and working mothers, they've been a huge part of the job increase here of getting back into the workforce because they can work remotely. I don't think that's necessarily a bad thing for everybody. But I will say that at some point, if you're working from home 4 days a week or even 5 days a week, I do think I've talked to top tech executives at Fortune 500 companies. You can't tell me. I know for a fact they're going to say at some point, if you're working from home making $150,000 in New York or Chicago, why can't I just go to a third world country somewhere else, a developing area, pay somebody $40,000? It's the same concept. So I do think at a certain point there will be layoffs. It's sad. I'm not rooting for this or anything, but I think that could be the catalyst where you do have a little bit more pressure on the work from home people, on the kind of these white collar jobs that can get replaced with AI and things like that. That could be the catalyst where you see office come back. You could see the suits come back. You could see the just that old school work culture, I think, come back. And I'm not old school in a bad sense. I'm not saying we should go back to everything from the past, but just more of that culture of we're a team, we're in the office together, we're working together towards a common goal, we're all wearing suits, we're looking good. I don't know. That's my long-term call. Could be totally wrong.
Okay, well, you heard it here first, folks. Long-term call is we're all in suits in 10 years. That's what Nick said. You can quote him. No. All right. Well, thanks for the thoughts there, Nick. Join us next week. We're going to be covering another number of great companies, kind of round out this earnings season, and then kicking off next quarter's earnings season. UBS, Dell, UiPath, Dave & Buster's, Toro Company, DocuSign, Kroger, Oracle, Casey's General Store, Adobe, Lennar, GameStop, Smith & Wesson. Remember, if you like the show, like it, share it with your friends. I know we're talking about throwing it on Spotify as well, if there are people who prefer listening to it there also. If you'd like to learn more about Stenger Family Office, visit our website. Give us a call at 630-912-8431. You'll get Julia. She's wonderful. You'll love talking to her. Request a complimentary starter kit. Remember, you can get you can start a relationship with us for just $1,000. 2 events now before the end of the year. September 20th, happy hour down in Spring, Texas, to celebrate the opening of our office down there. Join us if you're in the Houston area. We'd love to meet you. November 14th and 15th, we have our annual Investor Day at Hotel Indigo up here in Naperville. Thank you for listening, and we hope you have a great weekend.